Okay, my button's blue. Are you guys ready?
Is the red light on? Yes.
All right, I'm starting mine.
My button's lost. Hold on, let me see.
Not the button, not the gumdrop button.
So are we holding questions till the end? Because I know we have a couple questions coming.
Yes. Or
Great.
I don't know, we can just answer them during, that's fine.
Oh, the title is required.
Lexi, is yours working?
I just click the go live button.
Great. All right. Well, since we've had a bit of technical difficulties, we're just getting set up now. And so we haven't actually introduced ourselves to everyone in this room. Us girls all know each other because we're related. Lexi is my sister and McCall is my cousin. So we can just go through introductions super quickly. Tim is actually a lender here in North Carolina in Charlotte. And so we're going to ask him a few questions, mostly questions that we get asked very frequently from our clients, and touch on some newsworthy lender aspects, and then open it up for questions. Feel free to send your questions as you have them, and we'll try to incorporate them as we go. A worst case, we'll answer them all at the end. So I'm Catherine. I work here in Charlotte, North Carolina. I'm a realtor and I own a creative agency. And got started in real estate because my dad is a builder, Lexi's dad as well. And so we've kind of been in the new construction business for quite a while, and I always worked on the marketing side. Now I'm on the sales side. So pass the mic off to Lexi.
I'm Lexi Witt. I'm with Keller Williams Tri-Cities in Washington State. I started my real estate career, again, like Catherine, with our parents' new construction company. And so after 6 years of building across this part of Washington State, our parents finally decided to retire. So, but COVID happened before we were able to have a really nice retirement party for them. So the plan is when the pandemic is over to have a big party, I think, for mom and dad.
Whoop, whoop.
I love that.
So, yeah, I want to do it at Goose Ridge because they all, Catherine and I were there, or no, what were we doing? Catherine was trying to mooch off of my Goose Ridge subscription because I'm part of the wine club. And I called them and I'm like, my sister's going to come in. Is it okay if she just pays for some Goose Ridge with my membership? And they're like, oh, you guys are Les's daughters. It's like all of Goose Ridge knew who we were. Okay.
Well, last time I was in Tri-Cities, Catherine took me to Goose Ridge, so I'm part of the plan too. So I am Catherine and Lexi's cousin. My name is McCall. Growing up in Seattle, I always wanted to be a realtor. My parents made me go to college first, encouraged me to go to college first, and then I got licensed the day after graduation. So I've never had a real job. So we're, in real estate for different reasons, but now moving to Jacksonville, Florida, prioritizing family and not such a crazy work schedule. I'm taking a more behind the scenes role here in Jacksonville as director of operations for a 6-person women-led team. And I'm, 9 to 5 and kind of running the team behind the scenes. So yeah, that's my story.
And we are the Real Estate Cousins. We're working on a better name for this, but
it's a working title. Tim, tell us about yourself.
Well, first of all, I love the name Real Estate Cousins. Definitely stick with that. You guys are going to kill it. My name is Tim. I have worked with, let's just say, every spectrum of the lending industry you could think of. Bank of America, Wells Fargo, the corporate banks, the lenders, the brokerage firms. And what I came to realize is that working for a lender that's able to price out options based on your specific criteria is going to be your best bet, because not every single bank is going to give you the best deal, depending on, exactly what your credit score is, what your actual debt to income ratio is, there's a lot of variables, let's just say, that goes into the lending process. So the main question that I saw, one of the first questions a lot of people ask is the difference between a pre-qualification and a pre-approval. So guys, that is something you have to know. You can talk to any loan officer and on the phone tell them my interest rate, that I'm looking for is 2.5, and I make $10,000 a month, yada, yada, yada. None of that actually holds weight until you get pre-approved, right? So you can tell a loan officer that you have $5,000 in income. However, if you're working on overtime, there is a certain percentage they calculate. If you're, for example, getting any kind of alimony or child support, the options are out there. Every borrower is different. And these are things that make the difference between a pre-qual and a pre-approval. A pre-approval takes a hard pull. So we would need to obviously see exactly what your credit score is between the 3 credit reporting agencies, whether it be, TransUnion, Equifax, and Experian. Everybody nowadays is like, oh, well, I know what my score is. It's right around here. If it's not at 620, guys, that is the bare minimum if you're looking at a purchase for most lenders to qualify. So keep that in mind. Also, when it comes to the difference between a pre-qual and a pre-approval, you have to send the documents. So it sounds like a lot, but it's really not too many documents they need. 2 months of pay stubs they're looking for, 2 months of your pay stubs, and also, 2 years of your W-2s. So I know a lot of people haven't gotten their 2020 W-2s yet. They're looking for your 18 and 19 W-2s. They will use that to qualify your income and send you a pre-approval. Until you have a credit pull and all documents submitted, you can tell anybody over the phone, they'll give you a pre-qualification. It doesn't hold any weight. You can't shop around until you have an actual pre-approval. Another question that a lot of rumors going around is,
Wait, before you get started on the next question, I have another rumor I'd like to sort out. Can you explain the Polish loan officer? Because I know that there's a story behind it and you're wearing the shirt. And so I feel like we have to just get off on that note first.
Yes, absolutely. So my first language was Polish. If you ever hear an accent, that's why. I do work with, Polish realtors, clients. However, it's a logo that I started for myself. And the Polish loan officer, you can speak English, just you don't have to speak Polish to work with me, guys. But the story behind it is really just, separating myself from all the other investors and all the other clients out there. I do have a chameleon. She's you know what? I would take you upstairs to show you guys, but she's acting a little shy today. So maybe next time. But yeah, that's kind of the logo. I'm the Polish loan officer. Again, I do work with Polish speaking clients. I do know, I would say enough to get around a German airport, but I do speak German as well. So definitely, any clients that are not maybe English speaking, let me know.
Hey, Lexi, take this one away. What's your next question for our lender here in German?
Ja, okay, auf Deutsch. Was machst du in deiner Freizeit?
Nicht so gut Deutsch, aber ich spreche.
Yeah, I took a lot of German and was an exchange student for a year in Bavaria.
Nice. Where at?
It was called Ruhsdorf. It was called. It's kind of by Passau.
Okay.
So I rarely ever use German at all. I should have taken Spanish, but
if I were to tell you this, ich heiße Timek und ich liebe Fußball spielen. Ich bin von Canada.
I've been to
yeah.
Canada.
Did I do good there?
You
Did I
like
do
you
all
like
right?
playing soccer? You're from Canada?
Yep.
Zach just wrote in and he said,
I just
"Boss
didn't.
boot."
I was wondering. Did I
So
do
when
good there?
buyers think that buying a home is like a foreign language, I don't think this is helping right now.
Yeah.
Okay, let's loop back around. So you did mention that the pre-qualification is the one to have, and how exactly does that affect the buyer's credit score?
Pre-approval. So you can get a pre-qualification without getting your credit pulled. It doesn't hold any weight. A pre-approval is going to be a one-time pull. So if you're going to go, for example, I know a lot of people have gotten the car financed. If you go to a car dealership, as you can see, after your car's financed, they usually pull your credit like 5 to 10 times. It's ridiculous amounts. That is not the case when it comes to getting a mortgage. It's a one-time hard pull. So that is something, a very big misconception a lot of buyers have in this industry, is thinking, okay, if I go to buy my first home, I'm going to be looking at getting my credit pulled 15, 20, 25 times. So it kind of discourages borrowers from shopping around. That is not the case with our lending company. We do a one-time pull. We get all of your trade lines and determine exactly where you're going to get the best deal. However, it is a one-time pull. So a very common misconception, again, I can't stress it enough, it is not going to affect your credit. Now, if you are shopping around with other lenders, it's always good to let them know, because if you have, for example, in 1 month's time, 5, 6, 7 credit pulls, by the time you get to closing, it could potentially affect your credit score by the time they pull it again. So definitely make sure you're honest with your lender, your loan officer. Let them know if you are shopping around and you have multiple pulls, because by the time everything is said and done, the underwriters may have to re-pull it again. And if your credit score has been pulled 8, 10, 9 times, that's where you start to see it go down a few points. Now, 1 or 2 pulls is not going to be the end of the world. You can have your credit pulled once or twice during the process. Now, nobody can promise you exactly whether it's going to go down a point or 2 or stay the same, because that's up to, the 3 trade lines: Equifax, TransUnion, and Experian. Now, that's something, again, I can't stress enough, you want to be honest about with your lender how many times your credit has been pulled, because if it's not too many times, guys, it's not going to be depriving to your credit score if you got it pulled once or twice. I just bought a new car recently and my credit score actually went up. But you have to make sure, even if you're buying a new car or a home, make it a point to your financial advisor that you're working with, your FIA or your loan officer, that you just want it pulled once, no matter what lender you're working with, whether it's a car or a home, because getting that pulled too many times can, I would say 5 to 10 points drop your credit score.
One of the things that we always advise our clients to not do leading up to closing is, buy furniture on credit or buy a new car, or make any big purchase, which I know sounds like a no-brainer, but you are buying a new house. And so if you do get a really awesome deal on a couch where you can get 0% down, or, whatever it is, that can be something that you don't even think about, and you accidentally do. And so I think it's really good to have these conversations up front to not scare clients, but also to inform them on, how this is actually going to affect their credit. And especially in this case, with letting them know that it's, not going to change your credit score, in a crazy way by buying your house, So thanks.
But also to let them know, like at Christmas time, you can buy your kids presents on your credit card. It's just, they need to know that too.
Right.
They don't have to halt all spending.
Yeah, it's just nothing that's like crazy beyond what you would normally spend. You can still use your credit card, but just not on crazy purchases.
Exactly.
That's all great to know. Thanks for that.
I am going to bring up another thing too. We have such a competitive market, I think, in all of our cities across the country. Do you think it makes a difference with your offers if you have a pre-approval versus a pre-qualification versus fully underwritten?
100%.
Right? So can you maybe explain, can you guys fully underwrite something without a contract in your hands? Or do you need to have the purchase and sale before you can do that?
You would need a purchase contract before you can have the underwriters fully approve the loan. Now, conditionally approved is a term we use in the mortgage industry, which means you're conditionally approved. There might be a few documents that they ask for, such as updated, if you have an existing property, mortgage statements, or if you have outdated bank statements, your new ones, because they, like we just talked about, want to see if you have any kind of large deposits coming out. So by the time you actually purchase your home, you want to make sure you're not, again, buying, too big or financing furniture or anything that was going to raise an eyebrow for the underwriter. The underwriter on a pre-approval is not going to be looking at anything except for the pay stubs, W-2s. If you're a 1099 employee, self-employed, they have to have your profit and loss statements. But that is the main difference, is you can go ahead and shop around for a home just by a loan officer telling you, hey, you're pre-qualified based off the information you gave me. But until an underwriter takes a look at the documents you submitted and qualifies your income, that is your golden ticket. You're not going to be able to really, when you're shopping around, you could be wasting everybody's time in the process by not knowing if you're actually qualified. So it's a very common misconception, again, for buyers. Pre-qualification doesn't mean you're pre-qualified really at all. Until you're pre-approved and you have submitted the necessary documents for the underwriter to review, that is when your actual ticket is valid.
Awesome. In the same vein, can you explain the credit pull window? We had a buyer last week. She was so fixated on, I know you probably are sick of how much does it affect my credit, but the millennial buyers are scared to death that we've been working with on the window, on how many of these 8 to 9 pulls. Like, is there a time frame or is that just a total rumor?
A time for it. So when it comes to the window, as far as how many pulls they can have?
Correct. Without just blasting their credit.
So for example, if a borrower has shopped around with 8 different lenders and they have 8 separate credit pulls, they will not affect your credit score. I would say 30 days minimum, but it could take up to 60 days before they actually see the 3 trade lines, see that, you have pulled your credit. Sorry about that. Can you guys still see me? Have pulled your credit. So technically speaking, you can pull your credit once, twice, 5, 6, 7 times, and it won't affect it for 30 to 60 days. However, if you're in a window of time of buying a home within a month or two, and then you have to re-pull your credit, that is where you don't want to have too many pulls, because your pre-approval is only valid for 90 days. Right. So if you have a pre-approval that expired that 90-day window, you have to re-pull your credit, but you had 10 pulls and your credit score goes underneath that, minimum credit score of 620. If you're, for example, at 625, had 8 credit pulls, it could bring it down to, a credit score that you just simply don't qualify with anymore.
Let me rephrase. So we've been taught as realtors that if someone has one inquiry, there's a window in which the credit bureaus know that this person may be comparing Bank of America to Bank of England. We have been taught, we weren't given a date of how long the window is, but we are told that if you pull one credit, then you can have up to 45 days that it's all within one shopping window. Is that false?
It's a good way to put it,
Okay.
because the rule is, typically 30 to 60 days. That's my rule of thumb. However, the credit bureaus report how they report, right? You can't change that. So TransUnion, Experian, Equifax are all going to tell you on different dates when your credit was pulled, and they always go by the middle score. So technically speaking, sure, you can take a gamble and wait 2 months after your pre-approval comes out. However, there is also a chance that the lender that's offering you the financing for your home will have to re-pull it just to make sure. And that's where we run into, as lenders and loan officers, a lot of complications, because people shop around again for, other financing, or they get their credit pulled too many times. So when the underwriter finally is ready to get the closing package out, they re-pull it and they're like, wait, why did it go down 40 points? Right. So that's something to keep in mind. I will say there's no actual rule, right? Because you would have to call Experian, Equifax, and TransUnion and see when they report on each different, pull that you've had, and they all report differently. So to answer the question, it is a fugazi, right? Nobody has an exact date or an exact window of time. It's always good to know that, hey, if you're buying a home in, let's just say the next 2-3 months, don't get your credit pulled 18 times,
Thank you.
I always recommend to buyers that they get a couple they talk to a couple different lenders. One, because sometimes you just connect
better with one versus another,
especially with new construction, because you're working with these people for I hope you like that.
You're cutting in and out a bit.
I might need to change. I'm going to change locations here. Hold on.
Okay. But I think we got the gist of that. And yeah, I completely agree. I mean, I think we're all kind of in that same mentality. You want to get the best deal for your clients, and find that emotional connection to a lender. And I think that that's what's kind of cool about working with local lenders, is that you have a face to go with the name. Whereas, what Tim was saying early on this call, you don't always get that at the bigger banks, and you're kind of one of the many that go into underwriting right before closing. Whereas in working with a local lender, you actually have someone that you can call and see what the status is, and it goes into underwriting way earlier, and we're cleared to close, far in advance of the actual closing date. So yeah, I completely agree with you. I think that makes a lot of sense. Just having kind of a face with the name and getting your clients associated with that, the lender that kind of matches their personality. I think that's really important. So, and being able to kind of shop it around a little bit. So kind of transitioning into our next question about the ideal debt to income ratio. Can you kind of expand on that, Tim?
Yeah, absolutely. So there is 4 different products that are popular. You have conventional, FHA, VA, and USDA. All of these products have different guidelines. So let's go ahead and start with conventional, which is the most popular. You have 50% debt to income ratio requirements on a conventional loan. What that means is, I know it DTI, debt to income, may be a little scary. You're like, what does this mean? It's really easy, guys. Your debt, meaning anything that shows up on your credit report, such as car payments, current mortgage payments, your credit card payments, that is all calculated into your debt. All you have to do is divide that by your income, and you get your debt to income ratio. Now, if your debt to income ratio is above 50%, you do not qualify for a conventional. The guidelines on a conventional mortgage, this is where it gets a little tricky. This is where people get confused. A lot of borrowers think they need to put down the full 20%. That is not true. You can do a conventional mortgage by putting down only 5%. You do have what's called the borrower paid PMI. So you do still have a PMI payment. However, it falls off automatically after you reach the 20% equity the lender was looking for. Long story short, if you're a lender, right, put yourself in their shoes. If you're a bank, who are you going to go with? The guy that has 20% down or the guy that has 3.5% down? When you have more skin in the game, the banks are always willing to offer you less. Now, the PMI, which is also confused with MIP, it's the same thing, guys. PMI is private mortgage insurance. MIP is mortgage insurance premium. They're both the same thing. If you don't have the full 20%, they're going to charge it to you either way. Now, that is money straight out of your pocket going into the bank reserve in case you default or foreclose on your property. So if you default or foreclose, they have a little bit of, a safety net, let's just say. That's where your payment's going to. So it's always good to know, hey, you can go conventional without having to refinance from an FHA loan. Speaking of FHA loans, now here's the difference: 3.5% down payment. If you're looking at $100,000 loan amount, you're looking at $3,500. Do the math: 200,000, you're looking at 7,000. Keep going up from there. 3.5% down is all you need to qualify for an FHA loan. The DTI on an FHA is going to be 47%. That is right around the max. So you have a little bit lower of a DTI ratio most lenders accept. However, if you don't have the money, the whole 20%, or you want to go FHA because let's just say you don't have, anywhere near the 5%, you need to do 3.5%, always a good option. And you can always refinance depending where rates go to get to a conventional loan when you go FHA. The other loan product that I wanted to talk about is USDA and VA. If you go USDA or VA, the cool thing about those products is you do not have to put down any down payment. Also, the debt to income ratio for USDA for VA, is pretty much non-existent, right? So if you're a veteran, if you have any kind of disability, if you served our country, hey, hats off to you. I appreciate your service. And I think it's great what they're doing with this VA program, because you're literally saving yourself tens of thousands of dollars simply by being a veteran. And you guys deserve it, right? So VA loans are a completely different beast. You have no down payment. You have 100% financing. Pretty much you get into a home without paying a penny, right? So it's a great option if you are a veteran. USDA loans, I'll leave it here, guys, because I know I can talk everyone's ear off way too long. Those are loans where you have certain income county income limits, meaning if you make too much money, they won't approve you. Right now, they're right around 65 to 75,000 in most counties. And if you aren't making over that amount, they're actually going to incentivize you by giving you a loan with no down payment and 100% financing again. So there's a lot of different products out there, and finding out which one is for you, it's really just going to come down to, a few questions and seeing where you're at.
Is that 65 to 75 combined income? So if it was like wife?
Yeah. So if you're combined, if you have any kind, let's just say you're in a household, the USDA with every single dependent. So if you have one dependent or two or three dependents, they calculate that into your income. So it does go down depending on the dependents you have. That's just kind of a rule of thumb I use, but you can look at your county website, USDA county website, and figure it out exactly what the loan limits are. That's what I'm here for, guys. If you do have any questions, but yes, the amount of children you have in your home, dependents you have, spouses, that's going to make a difference as to what they calculate your annual income as.
I have a question that came in on one of our channels. With the DTI, are we looking at last year's total payments versus income, or are we looking at last month's minimum payment on credit cards, minimum car payment versus last month's paycheck?
So if you're looking at last year's W-2, right?
Okay.
Let's just say somebody makes 50,000. If you accumulated more debt, obviously since then, they are going to look at, your most recent. So 2022 or 2020 W-2s haven't came out yet. But let me make sure I'm understanding your question.
Is it an annualized basis or a monthly last 2 months basis for DTI? Was it last year?
That would be annualized.
Okay.
That will be annualized.
Okay.
Yes, ma'am.
Thank you. Thank you.
Awesome. Okay. Well, I think that this might be a good time to transition into talking a little bit about interest rates. So as we know, interest rates right now are kind of at an all-time low. So I'd love for you to kind of explain where things are at and a little bit more about how that all works.
Well, I wish you didn't say kind of, because it is at an all-time low. Literally the lowest rates we've seen in 30 years. I don't know how old some of our people watching are, or some of our potential borrowers, but that's the lowest it's been since I've almost been alive. It's definitely a great time to take advantage of rates if you're looking to refinance and you're in a higher rate. But when it comes to where they're at today, so right now we're looking at, on a conventional mortgage, interest rates in the lower twos. However, you do have to look at the term. A 15-year term mortgage is always going to have a lower interest rate associated with it rather than a 30-year. So it's a common misconception where people look at interest rates, the lowest ones advertised, but they don't realize that this is a 15-year loan option. So instead of your payment being $1,000 or $800 on your mortgage, your $800 payment on a 15 year is going to be $1,600 plus. So that's something to consider when you're shopping around for rates, especially these online ads you see everywhere. The interest rates themselves, I mean, it is the lowest it's been in 30 years. That's inevitable. It's a great time to be shopping around if you're refinancing or buying a home. Now, the way they fluctuate, there is variables that every bank or lender is going to consider before qualifying you for that rate. The main three is your credit score. So again, above 620. Now, if you're above 620, there is thresholds. So a 670 score, for example, or 680 score is going to have a different pricing than a 700 or 740. A 740 versus a 780 plus is going to have a different pricing engine, right? That could affect exactly how much basis points you pay for the rate. So guys, there is always variables. Those three variables, the actual credit score, the loan program that you're going with, those are the main things. Also debt to income. So if the bank sees your debt to income ratio is right on the cusp of qualifying, these are all factors they consider. They're always going to, it's almost like, imagine, a computer doing all this, because at the end of the day, guys, that is what it is. They look at everything. There's algorithms involved that take into play exactly what you're qualified for. So yeah, I can't tell you how many times I get a call from somebody saying, hey, I got offered a 2% rate. And I'm like, okay, 2% rate on a 30-year fixed, or, oh, he's like, no, 15-year fixed. Okay, what kind of credit score do they use? Oh, they use the 800. Well, hey, buddy, you're at a 600. So it's always something to be on the lookout for when it comes to getting an actual quote. People quote all day, but these variables come into play when it comes to your interest rate. So make sure that you're definitely checking all the boxes with your loan officer or lender, whoever you go with, before believing that's going to be your final closing package.
I feel like I need to add something to, if you are considering purchasing a house, say next year or in the summertime, you probably shouldn't be refinancing your house right now, correct? because you're going to end up paying all those fees and it might not be worth it. Is that something like, I feel like as a homeowner myself that, you know, you have to make that decision. Like, yeah, we're going to be saving a ton of money if we refinance now, which we did, by the way. We're saving like $400 a month because we refinanced. We went from 4% to 2.25%, which is crazy. So for us, that made a lot of sense because we don't plan on moving anytime soon. But I had a client that was looking for a house, and then she's like, but I think we might refinance, but then we still want to look in the summer. And I'm just like, well, right? What would you suggest to somebody that's thinking of?
And that's a question that is very tough to answer. Reason being, every situation's different, right? So if you're looking to buy a new home and you know for a fact you want to put an offer in a home next year, you have to look at the closing costs, attorney fees, title fees, all the things that come into the actual closing package, right? And see what your cost benefit analysis is. So you can easily determine that. Any kind of loan estimate, when you receive a loan estimate, you can always turn it down, right? You can apply for a loan, find out that, hey, you know what, the savings aren't there. However, a good loan officer like myself will be able to tell you based off the information provided, whether or not it's going to make sense. So for example, in your situation, saving $400 a month, right? Great. But if you're adding 8, 9,000, 10,000 to your back end loan amount, and when you go to sell your home to get your new home, who knows if that's going to break even, right? If 400 a month, multiply that by the time you sell your home and all the closing costs as well. So it is to each their own in that situation, whether it's worth it. I always recommend refinancing if you're at a 4% rate. I would always recommend somebody to at least explore the options, and we can give you a full cost benefit analysis before you sign all the final paperwork and call it a done deal. The one thing a lot of borrowers don't know is that you're protected by RESPA and TILA. So you have, as a borrower, a 3-day right to reside. After you get your final closing disclosure, you can still determine, just say, you know what, we want to sell sooner or we want to sell later. You can find out based on the cost benefit analysis of doing the refinance, whether it's worth it for you. And if you back out, no harm, no foul. Lenders nowadays, I know my lending company doesn't charge an application fee. There's no kind of cost involved in just exploring these options, right? So the worst thing that's going to happen is, you spent some time to find out if it was worth it. But to answer your question, it's really dependent on how much you're actually going to be saving over the course of the time you sell your home. If you're saving $400 a month, right? I mean, it could very well be better for you to do that and then sell your home in a year from now if the cost break-even analysis is worth it. That's something I can run that's something I run for all my clients, just to make sure they're not getting into a refinance that it's going to actually have their home sell for less, because there is costs and fees. I don't care who you talk to. When you refinance a home, you're going to have a higher loan amount when it comes to selling.
Great answer. Thank you so much for that.
Yeah, thank you.
Is that too much?
Not at all. I mean,
it's good. I didn't know that you can do that analysis.
Up, right?
Yeah, no, we all learned something. I'm taking notes over here. I don't know about you guys, but all right. Moving on to the next question, Tim. I know this is not the fun topic to talk about, but how has COVID affected the lending world?
So I would say for me personally, nothing. It hasn't affected me just because I don't shake hands. I'm not a big handshaker. I'm usually doing business over the phone. And at the end of the day, you're going to find the best lender that you work with, the lender that's going to offer you the lowest interest rate with the least amount of closing costs. is not going to be the next door neighbor that you can drive up to and say, hey, what's going on? Here's, give them a paycheck or a check, for your mortgage payment. Everything is online now. It's 2021. But when it comes to, some of the other borrowers that prefer that personal relationship, I think they're missing out by not reaching out to all these other lenders, because you have to realize there's thousands of them out there. So by simply using local lenders, you're almost shooting yourself in the foot. COVID has, sorry guys, you still see me? Okay. So COVID hasn't affected me in that way, because although we have a brick and mortar, majority of my business I do is over the phone, via email. After the loan closes, don't get me wrong, we celebrate. I've flown out to California to celebrate for a closing before, you know what I mean, from the East Coast, but it hasn't affected me. Now, how it's affected buyers, I don't think you guys have much to worry about, really. I mean, why not do everything online, non-touch delivery? The process is way faster. And with the market today, we all know it's a seller's market. These sellers are not going to accept an offer for somebody that wants to do, let's just say, a 60-day closing. And if you want to do everything in person, you're more than likely going to be looking at a 60-day closing. If you have a computer or a phone, you're looking at a 30-day closing, and your offer is way more likely to be accepted if it's going to be within 30 days versus 60. So I will say, to answer that question, it hasn't affected me and my company. Now, to others out there, possibly so. For the buyers, it shouldn't. I think that really it's a blessing in disguise. COVID has actually kind of got us all into a, world wide web of communication.
Awesome. I love that. Okay, switching gears a little bit. I do have a question from someone on YouTube. He writes, how do loans work if you're buying a house under market value, but you're hoping to get a loan to put money into a remodel?
All right. So we're talking about buying a home for under market value, but he wants to remodel. Correct. Sure. So let's budget, right? How much money do you comfortably want to spend on it? Any kind of fixer upper is going to come with a price, and determining what the price of, let's just say, the bathroom or the living room or the walls or the floors you want to fix. That's something that you definitely want to average. You want to get a good ballpark price of how much money you're going to put in extra, right? So if you're betting underneath the market value, I would say find out exactly what you're looking to fix on the home and find out a ballpark price, because there's contractors you can call and get a free quote. For example, if you have carpet in the living room, you want to do hardwood floors, call a contractor, see exactly what the price would be. Just so you have a ballpark idea of how much extra money, because a lot of these homes selling for undervalue that are fixer uppers could, we all watch HGTV, right? We've seen how much extra money you can put into a home, just based off of the repairs. So depending on the repairs, that's something I would definitely recommend looking into prior, and putting an offer in.
Great. Thank you.
That makes total sense. Do we have any other questions from viewers? Are you guys seeing any on your end?
No.
I wish I wasn't on my iPhone.
Well, last minute technical difficulties. We're just glad that you're able to make it. So
I keep looking out the window because we're supposed to be getting a snowstorm. Is it coming? Is it coming?
Is it snowing?
It started to snow. We're supposed to get a snowstorm, so
all I hear
is
is
yeah, well, here in Charlotte, we have what were we saying today? 6 days ahead of us of rain.
Well, Well, come on down to Florida. It was 85 degrees here, so I read my book outside on the patio. It was Well, it's so fun to see all of us from different areas of the country and ask questions that are affecting home buyers everywhere. I mean, every state is a titch different, but all in all, it is a seller's market. I think we can all agree on that. So Tim, where can people find you online? Are you able to lend in every state? What's the story?
North Carolina, South Carolina, and Florida for me. However, I have a great team that's licensed in 40 states. You tell me what state and I'll let you know if I'm not in there. But yeah, I don't feel like listing all 40 states. I'll send you guys a list of the ones I'm not licensed in. How about that?
Wonderful. That sounds
You
good.
have to end with telling us, or you have to say something in Polish.
Nazywam się Timek, jestem od Polski. No, na niemiecku nie mówimy za dobrze, ale myślałam, że pani nie wiedziała, że jak mówić niemiecku, no to bym myślał, że all right, I'll stop there. Yeah, I was gonna show you guys why I have the chameleon here. She has her own room, believe it or not. But yeah, I'm gonna see if she will come out.
What's her name?
So she is Babe Mulan Jankowski. Her first name is Babe. And her second name, or her middle name, is Mulan. You know Mulan, right? The movie.
Yeah.
Mm-hmm.
She's starting to shed a little bit.
So for anyone watching, Tim is the type of guy who's so easy to get along with. He will answer all of your questions. He's so intelligent yet just down to earth. So this is proof that he's authentically himself and he's the man.
And he must watch Disney films.
Hold on. Mulan's coming out, guys. Here she is.
Hey, Mulan.
Oh,
Nice to meet you.
look at her hands.
Yeah, she's shedding a
Sounds
little
really
bit.
good.
Yeah, she's right now going through her shedding stage, but yeah, that's Babe Mulan Jankowski for anybody that's wondering why I have a chameleon on my shirt. That's
You
the
have
reason.
Set the bar high, because now anyone else that joins our weekly calls is going to have to live up to your funny stories and your
Ending with a live animal.
Yeah. No, she's the best. And guys, I know that we didn't get too many specific questions on this call. The ones that I went over, I know it can be a little bit of a overwhelming process, right? With conventional VA, FHA, USDA, with my credit score. And at the end of the day, every borrower is unique, and there's a program out there, right? A lot of borrowers I've seen want to go with a program, like they're like, I want to go conventional. Like, I need to go conventional. I'm like, why? You don't have the money. So let's go FHA. There's so many different programs, and oh gosh, she's starting to crawl me. But let me know exactly what your situation is, right? And I'll be more than happy to help and figure out which program is the best one to go with.
Awesome. Well, we will put your contact information, if you're good with that, in the notes of our live videos, so people know where to find you. And we're excited to have you back on our, whatever this is, our live broadcast down the road.
Hey, it's our first run, guys. So with any viewers, hey, appreciate your patience as well, because it's our first run, but I look forward to hopefully some more in the future.
All right. Well, I made a friend tonight. I made 2 friends tonight. So nice to meet you both, and we'll see you around.
All right, guys.
Okay.
Bye. Say bye, babe. Say bye.
Bye.
Hold on. She was about to wave.